So probably the number one question I get asked on a daily basis is, Dan, when are rates finally going to start coming down? So we're starting to see that a little bit right now, especially after the Federal Reserve announced what they're going to do yesterday. But you see, we're way off our high. Just about a week ago, interest rates were over 8%, and now we're at about 7.6%. So we're about 40 basis points, or maybe a 0.5% lower than where we were just recently. But the concern that I have right now is how much spending the government is doing. And I'm a huge critic of that. And I get a lot of flack from you guys out there saying, Dan, you just don't have any feelings for, other countries or even our students who have this massive student loan debt. I do feel for that. But my concern is we're bankrupting our country to do all this stuff because we're funding it with money we don't have. Let me explain. Right through here, this actually explains to you, how does supply and demand work? Well, I'm going to get to something that really ties all this together here in a minute. When you have an oversupply of something, you have too much of something, what happens to the prices? Well, right through here, the prices fall. Like we saw in 2008. Why did the housing market crash? Well, it wasn't because house prices ran up so high. That wasn't it. The reason was a lot of people, or millions and millions of people, had subprime mortgages. And it got to the point where they couldn't afford those houses anymore because they were taking out those liar loans that we've talked about in the past. And now they just started throwing the houses on the market. They're like, I can't afford it, so I'm going to put my house up for sale. I'll just walk away from my house. It can go into foreclosure. And we had millions and millions and millions of homes hitting the market. We oversupplied the market, and that's why prices have fallen. Okay, so what has happened lately in the bond market is there's an oversupply of bonds. Bonds are issued by the federal government because we're not collecting enough revenue to actually fund the government. That's why I'm a huge critic of sending money all over the world and giving loan forgiveness to everybody, because let's show you right here. The federal government, how much did it spend in 2023? Well, so far in 2023, the federal government's collected $4.4 trillion, and you're like, okay, Dan, I love it. But then you go through here and they're actually spending in 2023 $6.13 trillion, or a deficit, or a non-funding of $1.7 trillion. So how do they do this? Well, they issue bonds, and they issue more bonds, and they issue more bonds, oversupplying the market, driving down the prices and interest rates up. How much is this costing our federal government right now? The tunes of $659 billion in interest alone. That's just interest. So if we keep giving out this free money to everybody, this is going to go to the point where we just can't pay it anymore. Or you're going to oversupply the market so much that yields are going to have to hit 10, 15, 20% for anybody even want to buy these bonds. So that's how it works. So if you watch my channel on a daily basis, you understand the bond markets and how this all works. So let's get over to the bond market right now of what we see. So right now, what we follow on this channel is the mortgage-backed securities market. It basically gives me an idea where mortgage rates are going. So what you see on the top of the screen right through here, that is the price of the bond. So when the price of the bond goes down, rates go up. When the price of the bond goes up, rates come down. You can see right now, the bond is, if you squint a little bit, it's up 25 basis points. That's good. That means rates are going to come down. Yesterday, this number was up over 100 basis points, driving down rates to these levels. You could just see yesterday alone, rates almost dropped 0.25% in one day. Okay, so that's what's going on in the bond market right now. The market is looking at current data that we're seeing right now, especially from the Fed. And what that current data is let's go over to the economic calendar. We've got a lot of good news coming in right now. I'll say it's good news for the Federal Reserve and the federal government, but it's not good news for me and you. Let me explain. Today, so far, we have initial jobless claims. Last reading was 212. They thought it would go down a little bit to 210. It actually upticked. That means more and more people just filed for unemployment. Non-farm payroll production means right through here, the last reading was 3.6, it's now at 4.7. So employers are getting more production out of people with less people, okay? Then you see labor cost, it's actually plummeting. Last reading was 3.2, now it's a negative 0.8. So employers are saying, we're not gonna pay you any more money to work. We're gonna require that you work a little bit harder and more. We're gonna do it with less people, and we're gonna pay you less. Why? Well, they gotta keep their profits in line. Because if you don't have the profits, well, your stock's going to tank. So the companies have to maneuver through all this to figure out what's going on behind the scenes. So that's truly what's going on right now. But this news on a slowing economy is helping give good news to the Fed, saying, okay, we think what we've done so far is kind of putting inflation in check, so we won't have to issue more and more and more bonds, hopefully to drive up rates even higher from where we are today. So that's basically the economic news that we have so far today. So let's get over to the markets that we're seeing. Is, like I said, you're seeing the bond markets doing a little bit of a rally right now. Here's where mortgage rates are. These are the top 6 products people use when they're buying their first house. Now, let me explain how these rates are created so you guys understand this. This rate is actually published by Mortgage News Daily. This is a national average for a borrower in this situation. What this reflects is somebody buying their first house. It's a primary home and a single family home. Those 3 criteria. Now, here's the dynamics of the borrower. They have a 740 credit score and they're putting down 20%. So if that's you, that's probably your mortgage rate. If that's not you, your mortgage rate's going to be a little different. How do you find out what you qualify for, and do you even qualify for? Well, the one thing I always ask people is, please don't disqualify yourself. If you're looking to buy a home in this market because you're sick and tired of paying your landlord's mortgage, you're sick and tired of your rents going up year after year after year, and many people say, Dan, even if you buy a house, your payment goes up. Well, it goes up a little bit. It'll go up if your taxes go up or your insurance goes up. So even if, let's say, for example, if you're renting, if your landlord's taxes went up and their insurance went up, by all means, they're going to raise rent on you. Plus, they want to also cover some risk factors. So they're going to raise it even higher. So if you're looking to buy a house right now and you just want to see, Dan, do I qualify based on my credit, my income, and the money I do have for a down payment? Love for you to visit us at therateupdate.com. 3 ways to reach out to us. 1 is the Apply Now button right up there. You're going to click that, answer a few questions, then you'll be assigned to a mortgage specialist on my team. But if you're like, hey, Dan, can I call? Can I email you? Absolutely, you can. Just scroll down to the bottom. You're going to see some blogs, some tutorials, some even mortgage calculators that you can use. But when you get to the bottom of the screen, what you're going to see is our contact information. You can give us a call at 844-775-5626, or you can email me personally, and I will respond, I promise you, at dan@therateupdate.com. Thanks so much for watching, guys. God bless, and I hope you learned something today. And if you did, please don't forget to subscribe down below. Take care. See you tomorrow.